how do I adjust my options insurance strategy? Are you wondering how to fine-tune your options insurance strategy? Let's break it down step by step to help you manage risk and protect your investments effectively. First, let's talk about what options insurance means. This strategy often involves using options contracts as a safety net for your stock holdings. Two common methods are protective puts and collars. Protective puts give you the right to sell your stock at a specific price, known as the strike price. This means if the stock price drops, you can still sell at the higher strike price, limiting your losses. However, remember that puts have expiration dates, so choosing the right timing and strike price is essential. Collars combine protective puts with covered calls. In this case, you buy a put option and sell a call option. The money you receive from selling the call helps pay for the put, making this strategy more cost-effective. However, keep in mind that this limits your potential gains since you may have to sell your stock at the call's strike price if it rises. Now, how do you adjust your strategy? Start by reassessing your risk tolerance and market outlook. If you anticipate increased volatility or a market downturn, consider buying puts with strike prices closer to the current stock price. This increases your protection. You might also want to extend the duration of the options to maintain coverage longer. Next, think about modifying your strike prices. Lower strike puts are cheaper but offer less protection. Higher strike puts cost more but provide better downside coverage. Adjusting the ratio of options to shares is also important. If you own 100 shares, you could buy one put contract for full protection or fewer contracts for partial coverage. Using collars can help reduce costs. Selling calls against your stock generates income that can finance your puts. Just remember, this will cap your upside potential. Keep an eye on implied volatility as well. When implied volatility is high, options become more expensive. If premiums are too high, you might want to wait before buying insurance or consider alternative strategies. Rolling options is another adjustment method. If your puts are nearing expiration or your market outlook changes, you can close your current position and open a new one with different strike prices or expiration dates to maintain protection. Lastly, consider alternatives like cash-secured puts or spreads. These strategies can provide downside protection with different risk and reward profiles. For example, if you own shares trading at $100 and want to protect against a drop below $95, you might buy a put with a $95 strike price expiring in 3 months. If the stock falls below $95, the put limits your loss. If you want to reduce costs, you could sell a call with a $105 strike price, creating a collar that helps pay for the put while capping your upside. Adjusting your options insurance strategy is all about balancing protection, cost, and your market expectations. Regularly reviewing your positions and market conditions will help ensure your insurance aligns with your investment goals and risk tolerance.